This is the DeFi Decoded podcast by 9 Point Partners in cooperation with Prophecy DeFi. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello and welcome back to another episode of DeFi Decoded. I'm Alex Tapscott here with co-host Andrew Young. You know, Andrew, I spent a lot of years in the financial services industry. I guess I still kind of work in the same industry. And for people who work on Wall Street or Bay Street, as it's known in Toronto, you kind of get used to the government being the big player in the space, especially when things go bad, you know, when it comes to government bailouts. In today's economy, even the biggest banks and corporations and private fortunes really pale in comparison to the power and influence of the Federal Reserve or the US government or here the Bank of Canada. And even when banks have worked together in modern times to stabilize the markets because of a crisis, it's usually with the not so invisible hand of the Federal Reserve kind of brokering the deal, as was the case with the hedge fund long-term capital management, which blew up in 1998. But this wasn't always the case. During the 19th and early 20th centuries, private banks and even some individual citizens had the financial capacity and the reputation to actually step in and stem a panic by acting as a lender of last resort. Cornelius Vanderbilt did it in 1873, rescuing a few troubled railroads and basically becoming the undisputed titan of the industry as a result. But perhaps the most famous example was during the panic of 1907, when J.P. Morgan, J. Pierpont Morgan, not the person, not the business, though at the time the two are kind of indistinguishable, played an almost godlike role, deciding which firms would die, like Knickerbocker Trust, and which would survive, like the Trust Company of America, National City Bank of New York, and so forth. And at the time, with the support of the US Treasury, but also with the country's wealthiest men like John Rockefeller, Morgan was actually able to calm the public and prevent a wider crisis. So they say history doesn't repeat, but it often rhymes. And today, crypto entrepreneur Sam Bankman Fried, worth $25 billion and the founder of FTX and Alameda Research, has sort of begun to step into the carnage of what's happening in crypto and scoop up distressed assets and lend money to troubled businesses. On Tuesday, FTX signed a term sheet with BlockFi a day after announcing a couple of acquisitions, including a Canadian crypto exchange. Bankman Fried was rumored as a white knight for Terra Luna and the unstable stablecoin UST. But I guess just like JP Morgan, who decided Knickerbocker Trust was insolvent, SBF passed on bailing out UST, and as we know, the rest is history. So what is happening right now? Is this sort of a repeat of those wildcat days of yore, where you know an individual can have the influence to save an industry? What's your perspective on all this?
Yeah, 100%. I mean, we don't have the backstop of the government to essentially nationalize industries or companies the same way that the government does with the banking system, which in a lot of ways makes this like a far more chaotic and sort of stressful environment to be a market participant in. But it's also kind of a more free market. So I think it's actually a much cleaner, much cleaner sort of environment where if you are insolvent, you're not going to be bailed out. Your equity holders will take a massive loss, which they likely should because they bear the upside, and you'll be essentially consumed by a larger rival. And I think over the space of 1 week, we've now seen 3 different acquisitions by FTX and FTX US. Earlier today, actually, FTX bought this clearinghouse company called crypto clearinghouse company called Embed, just as like another acquisition. So yeah, I mean, I actually think it's a much cleaner environment. There's no sort of moral hazard. There's not the same sort of moral hazard that you have in the traditional financial system, where heads I win, tails government loses kind of thing. So I'm actually, while it's more painful, I also think it's going to lead to a much faster decline, because there's no such thing as sort of zombie companies in crypto, at least to the same extent that there is in the traditional equity markets. If you get wiped out, you get wiped out very fast.
When you say zombie company, you're basically referring to a business that shouldn't exist or wouldn't exist if it weren't for government propping it up or supporting it in some way, right? That's the kind of definition of a zombie company.
Yeah, exactly. And you see that a lot in Europe. There's a ton of zombie banks. that essentially have no path to sustainability without huge government support, which to me is kind of a misallocation of resources, though I guess necessary to sort of stem the pain from the fallout.
Yeah, so I get the moral hazard argument, which is that when you bail out a business or when you guarantee depositor funds, you're basically passing risk on from shareholders and customers to taxpayers. And in the end, those could be probably some of the same people, right? And you incentivize risk-taking behavior because people in charge always know that no matter what, there's going to be someone else to foot the bill. The counterpoint to that is that with a lot of these lenders, because there's been no backstop on customer deposits or regulations in the way there is in the traditional financial system, it's also exacerbated the bank run itself. So it's true that we might have a more sharp V-shaped recovery, which maybe will help put it on a path to long-term sustainability. But in the short term, a lot of people are getting hurt. So is that an acceptable trade-off in your opinion?
Yeah, I mean, look, crypto has been one of the best performing asset classes ever over the last 5 years. I think everyone who's sort of an investor in this space knows that there's huge risks to trading. And I should also say, like, if you just buy and hold spot crypto, so without leverage, this short-term pain is obviously, it's very painful, but it's just paper wealth, right? Like, as long as you continue to hodl, over the long term, if your long-term conviction in the space is correct, you should be rewarded. The people who are really being hurt in this washout are leveraged traders, which to me, I mean, if you're using leverage to trade crypto, you are signing up for a ton of risk. With it comes obviously potentially a huge reward if you're right. So I think that's to me, that seems fine. These aren't sort of everyday depositors. It's a different type of thing, right? Like, there's a much higher risk reward ratio with crypto, and I think over time, as the industry becomes more and more institutionalized to the point that maybe eventually it's so large that it effectively becomes nationalized in a way, the rewards will be very high, but that also means there's no backstop, so the risk is also very high. But for the most part, like, people putting cash into Celsius, they were earning 8 or 9% yields on their stable coins, which is essentially 8 or 9% higher than you can get in your bank account. So I think everyone often on a very volatile crypto asset. So I think it's kind of, I don't know, to me, it's like, it seems pretty obvious that like, this is all sort of healthy. One thing I do want to point out also is that these are centralized sort of crypto finance companies. What we're seeing right now is a lot of the DeFi projects have sort of escaped a lot of the pain. And the reason why is that they don't have the same leverage that the custodial platforms do. And they are also far more transparent. So there's not the same sort of bank run panic that you have, where essentially people don't know if the entity is solvent or not. With DeFi, everything's on chain. You can see all of the bad debt. You can see what's going on. And you can also see that the platform's working in real time.
Yeah, to me, this is a classic problem where the mainstream media is reporting the story inaccurately. It reminds me a little bit of the whole thing about, well, I heard that Bitcoin was unhackable, but I keep hearing people lose their private keys, or these exchanges get hacked. And the point you have to make there is that, well, what's happening there is simply that some centralized company didn't do a good job of doing security well. It's nothing to do with the underlying blockchain or the integrity of the network. And here we're in this situation where the problem here is a problem of centralization, not decentralization, which is that you have these companies that are acting as these intermediaries and assuming all sorts of risk on behalf of customers. And when extreme financial strain occurs in the system, the customers are the ones that get harmed. In the DeFi space, as you said, everything is transparent and on-chain. And so customers and individuals who are using, I wouldn't say customers because they're not a company per se, but people who are engaging with those protocols know what they're signing up for, or at least should, because that information is available. And I always think that's an important distinction to make. So where does this industry go from here? Like, what does it look like? My personal view is that we're in the midst of a big liquidity crunch in markets generally. We're starting to see some demand destruction on the energy side, which is causing the fuel prices to roll over. And hopefully that passes through to the rest of the economy and helps to lower inflation. If that happens, maybe we get a reprieve on rates rising, markets snap back, and some of these extreme liquidity crises resolve themselves naturally. But you have to believe that the industry is going to look very different on the back of this than it does today. What does crypto look like a year from now?
Yeah, so I think so. Just to put on my macro hat for a second, because I can't help it. I agree with your assessment. It looks like the consensus is rapidly building that we're going to have a 75 basis point hike in July. We're likely going to have a recession if we're not already in a recession. In the US, GDP growth was actually negative in the first quarter. And if you look at the Atlanta Fed, which does like a nowcast of GDP, it's at exactly zero and been trending down.
Yeah,
and looks very likely that we're going to have negative growth this quarter as well. And 2 quarters in a row of negative GDP growth is actually what's defined as a recession. So we're actually already in a recession with massive the lagging effects of large interest rate increases. So I could see a scenario where we sort of have a snapback. It's almost like the taper tantrum, but on a bigger degree, where the market continues to go down. We have a recession, and then the Fed has to reverse hat and actually either pause rate hikes or and quantitative tightening, or even sort of drop them maybe early part of next year.
yeah.
Who knows? Obviously, that's the macro side, but at least from talking to people who've been right on the Fed being behind the inflation ball in this cycle, so guys like Larry Summers and Mohammed El-Ri, and I don't know how to say his name exactly, but they've been very right this cycle, and that's kind of what they're thinking is going to happen now.
Right.
Yeah, but so to answer your question though, on the crypto side, I'm actually I'm weirdly a big fan of these shakeouts. It really clears a lot of the dead wood out of the crypto industry and resets valuations. And essentially what happens is things that aren't pragmatic in any sense. So they're never going to have protocol earnings. They don't have a product, or sort of lagging behind on the fundamentals. Capital will reallocate away from those projects towards projects that actually do have revenue, working product, and sort of a community behind them. So in a lot of ways, it's kind of nice. It kills a lot of the noise in the space.
Well, that's what happens sometimes, like with tight money, right? It's like when there's so much money chasing everything around, investors are basically indiscriminate, and every half-baked idea gets the same sort of treatment in the market. And when money gets tight, you have to make trade-offs because you've got a scarce resource here you have to allocate to opportunities. And we've seen many of the most amazing innovations come out of crypto winters, namely Ethereum, which people forget was actually funded in a crowd sale when Bitcoin was at $250 in 2014, and went launched and live in September of 2015. This is a period that I recall, as I was around at the time, there being a small dedicated group of people who everyone thought was nuts. And maybe we're not that different now. We're just a bigger group, not a smaller group, but that was what happened then. And then the last cycle, DeFi summer and NFTs and the new alt layer ones and all these other things. So yeah, like I'm with you on that for sure. I wonder though, like going back to the consolidations thesis that we were discussing at the top of the show, do we end up emerging in an environment where Binance and CZ, who's the founder, and FTX and SBF, like these big centralized platforms, because they've had the war chest and the wherewithal to like grow during a crisis, end up more powerful on the other end? And then what does that mean? Like, are we now centralizing further? Like I think, for example, the roll up of these different exchanges, centralized exchanges, is an inevitability, and I think we've seen that in Canada a bit. But in general, I just wonder if the world of the decentralized world of crypto looks more centralized on the back of us.
Yeah, I think you're totally right. So the centralized world of crypto is going to become even more centralized. So what I mean by that is FTX will continue to scoop up sort of all these different startups, or I guess even peers, and really going to expand their product offering and really kind of expand their tentacles even further.
Yeah.
Which in some ways is actually good. because it means me as someone who's a depositor, I would rather put my funds in FTX Lend versus Celsius or like a smaller sort of more wildcat type lending platform. So in a lot of ways, it's actually good. It sort of decreases the risk potentially for everyone. And I guess in a lot of ways, it's probably good for DeFi too, because as the industry, theoretically, I guess, as the industry becomes more centralized in the centralized world, the value prop and competitiveness of the decentralized platforms should get higher because you don't have this sort of like market dominating centralized platform that can dictate terms everywhere. So I mean, it's tough. Like, I mean, I should also mention like DeFi hasn't been completely untouched by this downturn. A project I really want to highlight called Solend, which is like the main lending platform on Solana, has, I mean, a lot of people sort of argue that they're not DeFi because they're on Solana, but whatever, we'll sort of leave that argument aside. They had I believe it was $160 million loan outstanding on their platform that was about to be liquidated. And essentially what they did is they rushed a sort of fake governance proposal to take over that whale's account and liquidate him for him using an OTC broker. It was incredibly centralized sort of intervention due to the sort of crisis that would happen if they were to try to liquidate $160 million of Solana in this market. So that's led to a ton of sort of skepticism and a lot of kind of hate almost in the crypto sort of Twitter sphere, because people are like, this is just decentralized in name only.
Yeah.
But for the most part, I would say DeFi has definitely come out ahead on a relative scale.
Yeah, I would completely agree with you. And I wonder, I mean, the Solend thing is a complicated issue, but the idea of like the community gathering and voting in a way that they think is in the best interest of the network. I mean, people are making this point that this is governance in action, but it also seems to kind of undermine the nature of DeFi itself, right? So it's an interesting thing. In terms of what are you looking for catalysts here in the next little while? I clearly think that the moves by Alameda Research and FTX to like inject cash into the business, into the industry, is encouraging. I'll also point out that the Three Arrows Capital is this huge hedge fund, right, that we talked about last week. You were like, I think they're going bankrupt. And it turns out you were correct because they've completely been liquidated. And you can see this both in crypto, but also in the public reporting. So Grayscale's Bitcoin Trust, for example, on Bloomberg on June 16th, on Thursday, it said that they owned 38,888,000 units worth about $525 million US at the time. And on Friday, it was zero. And someone who's in the crypto fund business, we get reports of different ETFs here in Canada. And we did notice that two of our fellow ETFs in the market, Purpose and 3IQ, but Purpose in particular, saw its NAV cut in half. It looks like one colossal redemption. I'm not really sure, but it went from owning around 50,000 Bitcoins to around 25,000 Bitcoins in a single day. So too bad for Purpose. We feel for them, but it's interesting that it almost seems like Three Arrows is kind of out. I mean, like this is like the dump has been dumped, and maybe that was the weekend. The weekend was horrific. And all of a sudden things kind of recovered as if maybe the worst was behind us. So I'm humbled enough by this business to not say the worst is behind you until it's so far behind you that in retrospect you're kicking yourself for not buying more. But I do think that there was sort of a moment there where it seemed like there was just a huge sell wall, and obviously there were people in there to scoop it up. And so we'll see where we go from here. And Andrew, I might add that this is just me and you on the podcast today, but I did notice a guest appearance. There were a pair of legs on the right-hand side of the screen, which kind of moved in and out. So it's nice to have a guest, even though we didn't have one booked. I think that's basically it for this week. I don't know if you had anything else to.
Yeah, sorry, it looks like Alex got cut off there. I'd only add, it looks like I kind of agree with Alex. I think the Three Arrows situation is probably mostly sort of run its course at this point. I'm not really sure what the next steps are with them. We've yet to really get any sort of clear transparency on what's going on. And like whether it is actually the full sell-off has happened. A lot of people have been talking about some sort of bailout or full to get them back in the game, but it looks like it's going to be a lot of it is going to be settled in the bankruptcy courts, which will take months to play out. So not totally sure what's going to happen there, but either way, it's been a crazy week in crypto, and looking forward to seeing how everything shakes out over the next couple of weeks. Thanks again for tuning in to this week's DeFi Decoded. Myself, I'm Andrew, and my co-host Alex. We will continue to keep you informed on everything that's happening in this crazy crypto world. Thank you.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.